Jim Rickards is an American investment banker and author on matters of finance and precious metals.
The last time you were on, Jim, you took a lot of heat for a comment that you made that we had reached peak inflation. This was back in December. So it's clear now that the inflation train is still rolling forward here. Have you changed your stance since?
Yes, it's like I say, you're entitled to your own opinions, but you're not entitled to your own facts. And the facts are that inflation has played out longer than I expected, and exactly the way you described. One point that I would make is that when you say this is the highest inflation in since 1982, 40 years basically, that's true. But the inflation in 1982 that we're comparing it to was the end of the inflation. It started really in a severe form around 1976. And so by 1982, it had come down to 7.5% or thereabouts. So you're right about those numbers. But it was up to 15% in 1980. So 7.9 or whatever the last number was, in terms of the monthly inflation figures, yeah, that's pretty bad. But don't think it can't go a lot higher. It can. What I expected, and I still expect this. Let me put it this way: I still expect this, but I pushed out the time horizon because a lot has happened and we have more data. There are two kinds of inflation. And one is what they call cost push inflation. The other one is demand pull inflation. Those are economic jargon. But demand pull is when it's driven by the consumers, the everyday American or everyday person around the world. They see some inflation. They go ask the boss for a raise. They go, hey, I need more money to keep up. They accelerate purchases. Like, oh, gee, if that refrigerator is going to be more expensive 3 months from now, maybe I better buy it today before the price goes up. It kind of feeds on itself, but it's very much driven by consumer behavior, the behavior of labor and working people, trying to keep ahead of something that they're living through. So that's demand pull. The other kind of inflation is called cost push. That comes from the supply side. That basically is, an oil embargo or a war in Ukraine or economic sanctions or supply chain disruption. There could be a lot of causes or multiple causes, but basically it's not that the consumer has so much changed his or her perspective, but they can't get stuff, or the suppliers are raising the prices because, hey, our input prices are higher, so we have to raise the prices to consumers. Now you can have both. One can feed. It can start as sort of cost push, meaning it starts with supply chain disruption, comes from the supply side, but then the consumers say, hey, no mas, enough. I want to raise, and so it can feed on itself. The reason I make that distinction is because the Fed can possibly do something about the demand side. The Fed can, squash it by raising interest rates and raising mortgage rates and deflating asset values, et cetera. The Fed can't do anything about oil. The Fed can't do anything about the supply side. They maybe people think they can, but they can't. And that was what we saw. That was how it started in the 1970s. It started with the Arab oil embargo, which went through two separate phases, one with the Arab-Israeli war and then later with Iran. We had two separate, periods of spiking gas prices and gas lines in 1974, again in 1979. But that started from a supply side that the Fed couldn't do anything about, although the Fed probably was too easy at the start of it. So right now, this inflation has come from the supply side. Now, how will it play out on the demand side? That's the question.
I had one professor of applied economics on saying, look, this inflation has nothing to do with broken supply chains, et cetera. It solely has to do with money supply and the surplus of it. So would you say not so to that?
I completely disagree with that description, and I'll tell you why. And I've said this before. The Fed has exploded the money supply, so there's no question about that. M0 has gone up by 400%. The Fed's trying to rein it in a little bit, but when you go from 800 billion in 2008 to 4.3 trillion in 2013 when they started the taper to 7 or 8 trillion, which is where it was after the pandemic in the spring of 2020. There's no question about the money printing, but that money doesn't go anywhere. It doesn't do anything. It's basically the Fed expands M0 by buying bonds from the banks. They take the bonds on the portfolio. They give the money to the banks. Money comes out of thin air, but the banks just give it back to the Fed as a deposit in the form of excess reserves. So you're inflating the liability side, which are the excess reserves, and the asset side, which are the bonds, you've inflated your balance sheet, you've increased them zero, but you haven't done one thing for the economy. There's nothing about what I just described that goes into the real economy. Now, where does money for the real economy come from? It comes from commercial banks lending and consumers spending, and that shows up in velocity. And if you look at the velocity statistics, they've crashed in the last 10 years and they're still going down. So the reason so-called money printing doesn't turn into inflation is because the money doesn't go anywhere.
You're saying now, okay, it's not peak. You see it headed higher and lasting for how long? What's your current thesis here?
Okay,
and to what level?
Okay, well, that's why, great question. That's why I spent time on the supply side versus the demand side, because the demand side isn't really there yet. Velocity is not going up. People are noticing. I mean, they notice, and it has a huge political impact, but it's coming from the supply side. And I have spent a lot of time studying the supply chain, so I could see that. But then the war in Ukraine and the sanctions were like putting a turbocharger on it. Okay, it's worse and it's going to get worse. Okay, so how does that reverse? How does that turn into disinflation and finally deflation? The answer is there's a feedback loop. When price at the pump, first of all, gas prices are going up. We all know that. They've practically doubled, more than doubled.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information. And it helps us spread that message. Sharing is caring. And now, let's continue.
But people need to drive. There's some discretion, but you got to get to work. You got to visit the relatives. You're out there driving. So you don't have much choice about it. You just have to pay it. But that reduces your discretionary income. It means you're not going to buy something else. You're not going to go out to dinner. You're not going to buy a present. You're not going to buy a new TV set. There's some other thing that you're not going to buy because you had to spend more at the pump. And that would not be true if real wages are going up, but real wages are not going up. So monthly we get the employment report, and it's been showing that real wages went up, wages went up, let's say 5% on a year-over-year basis, and that's about what they've been going up. And everyone say, look, wages are going up. No, because that's 5% nominal. But we just said we have 7.5% inflation. So when you subtract the inflation from the nominal, real wages are negative. They're going down. So price at the pump is going up. Real wages are going down. People are miserable about that. But the only way they can deal with it, even though Bloomberg said eat lentils, I mean, that was let them eat cake, right? That was one of the most ridiculous columns I've ever seen. Take the bus and eat lentils instead of hamburgers. But that kind of lunacy aside, the way people adjust in the real world is they stop spending on something else. So that can slow the economy. We're seeing it already. Atlanta Fed GDP numbers have been quite low. I'm not forecasting a recession, but it wouldn't surprise me. We're seeing yield curve. We're seeing yield curve inversion, not just in the Treasury yield curve, but look in the Eurodollar futures yield curve in the reds actually, which are not that far out. That should never be inverted. That's like one of the clearest signs of a recession you can find.
Do you think that the Fed will be able to orchestrate this soft landing without triggering the recession?
Well, no, and they failed before. We've seen this movie. Remember, they tried to do this starting in 2013. That's when Bernanke announced the taper and everything fell apart, so they delayed it. But they started the taper in, I think, November 2013. They finished the taper in November 2014. Janet Yellen waited until December 2015 to raise rates just 25 basis points and waited another year to December 2016 to raise them again. Then it was handed off to Powell. And then he began a steady state of rate increases, basically 25 basis points at every meeting. He got rates up to 2.25%, and he got the balance sheet down from about $4.5 trillion to like $3.6 trillion over the course of 2017, 2018. What happened next? October 1st to December 24th, 2018, the stock market crashed 20%. That's because, and then what did Jay Powell do? He stopped rate hikes. He started a new taper, new QE6 or whatever at that point, and he cut rates. And then we went right into the pandemic and rates are back to zero and the balance sheet tripled. So he failed and the stock market crashed in the process. So now we're doing it again. But Wall Street, it's not going to take as long to play out because Wall Street has seen this movie before. So here's the thing. This is your question. Can the Fed normalize interest rates, which I would call about 2.5%, and normalize the balance sheet, which I would call around 3 trillion, without causing a recession or a stock market crash or both? The answer is no. But the problem with the Fed is they're usually the last to know. Like I just told you, you get it. The viewers get it. But Jay Powell will be like the last one, other than some of the other governors, to understand what we just said. And so we'll probably get the recession and the crash before the Fed gets the wake-up call. But no, they can't do it.
Okay. So I just want to clarify because I thought you said you didn't think we'd see a recession, but you think.
Well, I'm not. As of this minute, based on all the information we have, it's hard to predict. Although it's very likely, we're seeing a lot of signs that could be true. But as the Fed goes down this path, which they not only said they're going to do, but Jay Powell upped the ante the other day, said we might do 50 basis points. Okay.
Yeah.
They go down that path, then they will cause a recession. That will absolutely happen. But whether it's late this year, early next year, or it could be sooner based on. See, now here's where it gets a little more complicated because the economy, the global economy, and the U.S. economy would be slowing drastically anyway because of the sanctions and the economic war with Russia and energy shortages, etc. That would be happening anyway. The Fed has got a quadruple tightening exercise going on. So they just tapered. So that's one. They just raised rates. That's two. They previewed the fact that they might actually reduce the balance sheet. That's quantitative tightening, or QT. That's three. And then in the last dot plot, even though the dots are kind of a joke, said that they would have more rate hikes sooner than people expected. So that's a quadruple tightening. Taper's over, QE's about to begin, rates are going up, and they may be going up for a long time. That's a recipe for a recession. Well, stock market crashes tend to happen very quickly. They're slower in the bond market, and global recessions build kind of slowly, and global liquidity crises, they seem to happen very quickly, and they do, but they build for a while, and so we're seeing all these things. Stock market kind of is almost the last to know, but one day the stock market wakes up and says, "Oh, gee, growth is zero, recession's looming, the war's continuing, the sanctions are getting worse, the supply chain's busted. I guess we better reprice." And you can go down 20% in a matter of weeks.
A matter of weeks.